The US markets rallied over 3% in back-to-back weeks on the hopes that things were finally going to get back to normal. But in typical 2020 fashion, nothing seems normal this year.
As Matt already mentioned, the U.S. markets were up 3% last week, as the S&P 500 and the Russell were up just under 3%, while the Nasdaq was up about 1.7%, and the Dow Jones was up almost 4%. So last week we saw a little bit of a rotation out of the technology sector, even though still up about 2%, into some of the larger cap companies that are in the Dow. But it's also important to mention that the Russell 2000 and the Dow Jones are still down double digits for the year. Most of the returns came on Tuesday and Wednesday last week as states continue to reopen. But then on Wednesday afternoon, President Trump announced that he was going to have a press conference on Friday regarding China. Now on Thursday through the morning on Friday, the market sold off a little bit as investors were a little bit afraid that President Trump may be putting sanctions and tariffs on China. But at the end of the day, that ended up not happening. And then after the press conference on Friday, the market rallied back to even.
Wealth Management Advisor with this week's charts. We're going to take a look at the S&P 500 as well as the Shanghai Composite Index. First, we're going to start with the S&P 500 here on a monthly basis. Since it is the start of a new month, you can see we did get some follow through last month and did close over this major 3,000 psychological and resistance zone from that 3,000 to 3,020 zone. So very, very good action over the course of the month. We had that clean rejection of the lows and that breakout zone from back in 2017 earlier this year. So market held where it needed to, made a super sharp bounce. It is now starting to hold over that resistance zone, which on a monthly basis, we only have two higher monthly closes, and that was the last 2 months of last year. We're going to be looking at those two levels. Our next resistance point's in at about that 31 and some change, and then back up around that 3,200 level when we look at this on a monthly charting basis. Now, next, we want to take a look at the Shanghai Composite Index with all of the news once again between the U.S. and China. When we take a look at the Shanghai here on a weekly chart, we have been in a clean downtrend here since the beginning of 2018. So you can see we have a series of lower highs, and since the middle end of 2019, we have a series of lower lows as well. So this downtrend is still intact. We have this channel down. We're going to continue to watch what happens here. It will be very, very important for the Shanghai to get up above that 2,900 zone, but really it's going to be above that 3,050. You want to see a higher high in terms of a weekly close without seeing any sort of move to the downside. But we definitely want to pay very close attention here with all the political pressure between the two countries. And we'll keep looking at how the Shanghai is performing as we move forward.
Obviously, the biggest news story from last week was the once peaceful protests that were hijacked and turned into violent riots across many cities of our country. And although the situation is completely awful, we don't feel that this has a drastic impact on the markets. But something that did happen over the weekend that we feel could have a long-lasting impact on the market is the news that came out of China. China publicly told their state-run agricultural companies to stop purchasing agricultural goods from the United States, and also announced that they're going to be purchasing their soybeans directly from Brazil. This is a direct shot at the Phase 1 trade deal, and I think it's safe to assume that the Phase 1 trade deal is essentially null and void at this point. And it's going to be really interesting to see if President Trump can get China back to the negotiating table during an election year. We're now entering the final month of the second quarter, and we knew that the second quarter was going to be a rough one for the economy, but we just didn't know how bad it was going to be. Well, the Atlanta Fed released their GDP model, and they said that they predict the economy is going to shrink by over 51% in the second quarter. These are numbers, and I know I've said this a lot lately, that we haven't seen since the Great Depression. So the question that still remains is, can the Fed continue to prop up the market long enough for the economy to rebound and catch back up? And hopefully our cities can start getting back open as planned. And we can get back to normal sooner than later, if we really even remember what normal is. Thanks for watching, and if you find this content valuable, please subscribe to our channel.